Hello financial fans, welcome back to another stock analysis. Today we'll be covering Canadian National Railway stock ticker CNI. Canadian National Railway, or CN, is a major transportation company in Canada. It operates a vast network of railway tracks spanning over 33,000 kilometers across Canada and the United States, serving major cities and ports as well as remote communities. CN is primarily a freight railway company, meaning that it transports goods rather than passengers. The company carries a diverse range of products including raw materials, manufactured goods, and agricultural products. Some of the key industries CN serves include mining, oil and gas, forestry, automotive, and agriculture. In addition to railway transportation, CN also offers a range of related services such as intermodal shipping, combining rail, truck, and other modes of transport, warehousing, and supply chain management. The company also operates a fleet of trucks and provides logistics service to customers. They are currently sitting at a $78.7 billion market cap, and their revenue in 2022 was sitting at $12.6 billion. And a dividend yield is 1.98%. 24% of their revenue comes from intermodal, 18% from petroleum and chemicals, 17% from grain and fertilizers, 15% from forest products, 10% from metals and minerals, 6% from automotive, 4% from coal, and the remaining 6% from other various income streams. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, financial health, and the growth of the company, and we'll be using a standard margin of safety of 25% that can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors on a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from almost $3.9 billion in 2013 to almost $8 billion in 2022. The average EBIT growth was 8.6% average on year over year, which is no change in the margin of safety. The margin growth, or rather the margin, has also increased, going from 36.6% in 2013 to 46.1% in 2022. The average margin growth was 2.7% annually, which is a 5% deduction in the margin of safety. The next two ratios are dividend growth and the payout ratio. The dividends have gone up over the years, going from 88 cents a share in 2015 to $2.24 a share in 2023. The average EBIT growth, or the average dividend growth rather, was 12.5%, meaning 10% deduction in a margin of safety. This with a payout ratio that's sitting at 39.2%, which means no change in margin of safety. I just saw that the chart is currently incorrect, but it is sitting at 39.2%. The final two ratios are the debt to EBITDA and return on invested capital. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For CN, this is just over 1.5 years, in this case a 162% debt to EBITDA ratio, meaning no change in the margin of safety. The return on invested capital is sitting at a very solid 12.5%, meaning that its management is very effective at allocating capital, which is a 5% deduction in margin of safety. Looking pretty good so far for CN. Let's look at the valuation models next to determine the intrinsic value of the company. The first valuation model we'll be using is the discounted cash flow model. I've imported the free cash flow of CN going from 2013 to 2022. The average growth in free cash flow annually during this period was 9.71%, and I'm projecting an expected growth rate in their free cash flow of 7% over the next 10 years. With this percentage, we can determine the future free cash flow of CN and determine the terminal year of valuation, using a perpetual growth rate of 3% and a discount rate of 8.5%, giving us a sum of free cash flow of $71.1 billion. And to get an equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $55.6 billion. All the stuff to do to get our fair value is divided by the amount of shares outstanding, giving us a discounted cash flow price per share of $82.72, which is a 28.87% downside out of this model. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of CN going from 4 years ago to the current year. The average growth rate in dividend during this period was 12.5%, and I'm projecting expected growth rate in their dividends of 7% going forward. And we'll be using a discount rate of 8.5% once again in this valuation, giving us a dividend discount model price per share of $159.79, which is a 37.39% upside from the current price. The third model that we use is Graham's revised valuation formula. In this model, we look at the earnings per share that CN is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds. And we go by the theory that a company of no growth is always sitting at a PE of 7. Taking all of these metrics into account, we get a fair value of $75.08, which is a 35.45% downside out of this model. The fourth model that we use is the multiple valuation. In this model, we look at similar companies to CN, look at their stock price and their earnings per share. This way we could determine the average PE multiple in the industry, which in this case is 18.99. All I have to do to get a fair value is to multiply by the earnings per share that CN is generating, which in this case is $5.46 a share, giving us a fair value of $103.70, which is a 10.83% downside out of this model. And the last model that we use is the mean reversion theory. This model, we go by the theory that a company will always trade above or below its mean, and the metric that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average it has been sitting at 1.77%. Meanwhile, the current yield is sitting at 2%, meaning that it's currently undervalued on this metric. With the PE ratio, we're going to do the same, and the average PE multiple of the past 5 years has been sitting at 20.16, while the current PE ratio is 21.30. This means it's overvalued on this metric, giving us a fair value at the end of $120.89, which is 3.94% upside out of this model. If you want access to all of the models that I use in my videos and more, you can check in the description for my Patreon link. Getting my self-promotion out of the way, let's go look at the final overview of our valuation next. Looking at the final overview, we have imported our discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $108.43. A margin of safety we've determined earlier, using the standard margin of safety 25%, deducting 5% for the margin growth, deducting 5% for return on invested capital, and 10% for the dividend growth, giving us a 5% margin of safety. Applying this margin of safety, we get a fair value of $103.01. And with the current price of $116.30, this is a downside of 11.43%, meaning that's currently indicating a sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.